Hello and welcome to SB Talks, where I am once again joined by our Chief Investment Officer, Ashley Owen. Today is Thursday, September 15th, and we will be discussing, amongst other things, the latest inflation numbers from the States, the outlook for interest rates, market gyrations, and much more. Welcome, Ashley.
Welcome, Vince, and welcome to all of us out there in the world.
So, Ashley, in the last 48 hours, US inflation numbers came in, saw core inflation at 6.3%. Markets had got pretty excited in the lead up to this announcement and jumped about 5% and then gave it all back in the course of about 24 hours.
Yeah, it was funny. The US market was down about 4 to 5% a couple of nights ago because inflation came in lower than the previous month. But as you rightly say, that it was the core inflation, excluding oil and food, that rose to 6.3-ish%. The biggest increases, despite the fallback in oil prices, the biggest increases was a lot of household items, food, clothing. I think health insurance is up like 20-odd%. So a lot of things are flowing through from a whole bunch of different things, including supply, but not just supply problems or wage problems. A lot of the expense items are rising for a whole lot of different reasons. Some are temporary, some are permanent, or less temporary. So the headlines in the morning after were bloodbath on Wall Street. Of course, the market just sort of lost what it had put on the previous week.
So reverted to 7 days ago.
When markets jump 4%, you don't get sort of bubble bath in Wall Street. You just get ho-hum. And when they fall off, it's all of a sudden there's this bloodbath end of the world.
It goes up in percentage points and it comes down in trillions of dollars or whatever the headline is.
You know, ASX wiped off $62 billion
in 1 hour.
But it's up, $400 billion. Anyway, so it's silly stuff. But I try and ignore the day-to-day stuff, but the problem is clients ring up and say, what about this? Do I jump off the building now or wait next week? Or is it the end of the world? Or do I go and sell everything and go to Fiji? And the answer is no, 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 yes, no, no, in that order.
Just you need to make sure you get that order.
That's right. So it's all very silly. The point is that shares globally, which is basically 60% US shares and about 2% Australian of the global market, by and large are not expensive based on a whole bunch of measures. Profits are very strong, dividends are very strong. The underlying earnings engine of American companies and Australian companies is quite strong. A lot of it in Australia is based on temporary commodity price spikes, which has come off. I mean, iron ore is back to $100 a tonne now, but it was a year and a half ago, actually 2 years ago, a couple of $100 a tonne. Most industrial metals prices have fallen this year because of a slowing China and the sort of world slipping into recession. But on the other side, you've got oil and natural gas has more than doubled, coal prices have more than doubled, all of which is sort of temporary European problems.
The energy pinch out of Eastern Europe.
That's right, but
ignoring
commodities which are very cyclical and temporary in nature, the underlying engines of earnings of companies like Microsoft and Apple and Google and those sort of companies they're fully priced, but they're based on growth that they've experienced for many years and probably will continue to experience in the future as the world gets richer and population grows, just the engine of growth generally, ignoring all the ups and downs. So the bottom line is that interest rates are rising, which is always scary to investors. Interest rates, we've had 5 rate hikes in Australia in 5 months. US has had 4, but they're about 1% ahead of us. They're probably going to raise rates, but this is the big debate this week. Are they going to raise rates by 75 basis points next Wednesday, Thursday, or is it going to be 100 basis points?
It's almost before the inflation number. There was an excitement that they possibly might only have to do 0.5%, and now the reality is maybe it's closer to 1%.
So it's, but if you ignore all the temporary stuff, at the end of the day, interest rates around the world, Australia, UK, Europe's lower, Japan's lower, but America, UK, Canada, New Zealand, Australia, they're roughly sitting around today at about half they were pre-GFC and pre all the silly QE stuff. And they're about half of their rates that you'd expect in just a normal functioning economy, with inflation running at 2 or 3%, with GDP growth running at 2 or 3%. Cash rate should be around about 4 or 5%, have been for decades and will be in the decades in future. The problem is now they've gone from 0 to 2-ish.
in such a short time frame. I think that's it. We've had ultra low interest rates. We've had significant amounts of money swashing around in the system. And
it's not short term. It's not fast. In February 2020, everything dropped from 2, 3, 4, 5% to zero in a day. That's fast. We're going back, probably taking a yearish or two. It's been sort of 6 months into the rate hike cycle so far.
I would argue that going from 0% interest rates to say north of 2 in the space of 3 months will be a shock to many in the system. Perhaps not to people that have experienced much worse than that decades ago, but to younger borrowers, to people that have not experienced an interest rate rise in their professional life, this will be impacting them, and the full impact of it is probably yet to be seen.
Yes, so rates are heading in Australia, US, Canada, UK are heading towards 4 or 5-ish%. I've been saying that for several years. It's now coming to pass. It'll probably take a year or two to do.
So realistically, through the middle of next year, we're in that territory.
Right. So interest rates now are roughly half where they should be if inflation is normal, 2 or 3%. But it's not. Inflation is running at 7, 8, 9, 10%. So a lot of that will come off when prices come down. And you're seeing that with commodities already.
But we still have core inflation north of 6 in the States, and in the UK is actually the exact same number right now. And that's going to take a lot of heavy lifting from a policy perspective to get it down sub 5, sub 4 even.
Yes, it has not yet translated into wage claim. We've got strikes all over Australia and around the world, but unionisation's very low. The world now runs on Uber-type jobs rather than real jobs, in inverted commas, and that means that you don't have the ability to walk out. Mind you, the summit we had the other day, where they've returned to sort of collective bargaining, industry-wide bargaining, which is like the bad old days of the 70s. The
multi-employer collective deal.
That's not a good step for wages.
And you're seeing more of that kind of activity. If I look at the UK, the rail strikes have been rolling on all through their summer. Definitely, I think, at lower income levels, when the cost of living has gone up as it has and continues to go up, the pressure it's harder to hold back denying people, let's say, those wage increases to adjust for cost of living, which is then really can see inflation get embedded into the system once that begins to occur.
If it does, and if there's a wage price spiral like there was in the 70s all over the world, especially US, Australia, that's where you see inflation entrenched, and that's very hard to undo. I don't see that getting to that point, double-digit inflation or consistent double-digit inflation. But probably inflation will remain higher than target range for several years for a whole lot of reasons, even when the Europe energy prices are solved.
And we've spoken before on this podcast. It's sort of a lot of the tough talk out of the Fed is about trying to give people confidence that they're going to do whatever it takes, hence almost kill off the thought of some of that inflation before it even happens. There's a lot of psychological aspects at play here as well as just the fundamentals of the rates.
That's right. So you've got Philip Lowe here, less than a year ago, saying we're going to set expectations of zero rates for 3 years, which is exactly the wrong message. And then you've got Jay Powell now in the US saying we're going to keep hiking rates until we kill it. And that's probably not going to happen either, because he will probably have to pause. Now, the other thing that's happening is that the jobs market in America is very strong. Unemployment was down to 3.5% for a couple of months. Last week, a couple of weeks ago, we saw the number tick up a bit, more wage claims, more jobless claims. Unemployment went from 3.5 to 3.7%. So that could be the starting of a job slowdown, which the Fed wants to see. So that, normally in a recession, in an interest rate reduced recession like this, you want to see unemployment rise to 5, 6, 7% like it did in COVID, and then stay there, because unemployment, once it's high, it takes a decade to come down. I think hopefully governments have learned not to throw stupid money at everyone all at once like they did in 2020, because it's purely inflationary as we're seeing now. So that cash splash won't occur again, A, because they've learnt the lesson hopefully, and B, because they're now $1 trillion more in debt than they were before it happened. So probably inflation will have to see unemployment rise to 4, 5, 6%, which will take cash out of people's pockets. Meanwhile, cash rates are rising, increasing mortgage prices, mortgage interest rates, and repayment. So that takes money out of people's pockets to buy and spend on stuff. So all of that reduction in demand will hopefully bring down inflation to somewhere near normal range, which is 2 or 3%.
But that will
It'll take a while.
It'll take time.
It'll take a while. Meanwhile, cash rates are going to rise all around the world, probably double where they are now. So rather than think about 2s and 3s, start thinking about.
But we're probably realistically going to head both here and overseas north of 3 very quickly, and then maybe at a more moderate rate from there on up into the mid-4 territory.
Once they see jobs being hit, that's a good sign, and unfortunately that's going to be a sign where political pressure will come to bear on them to slow the rate rises. They shouldn't, and there's no logical reason why they should. That's in fact why they're doing it. But there's a lot of pressure now. Central banks were independent from the early 90s to GFC. Now central banks are simply a tool of government to help them finance their deficits. So they'll be told what to do, and there'll be a lot of political pressure to start to pause the rate hikes, which means inflation will not be killed. Don't forget that in the 70s inflation, Paul Volcker in 80-81 caused a massive double-dip recessions by raising rates to 20%, killed the economy, double-dip recession. Reagan just got in a second term, but it was very painful, very deep, a bit like Thatcher in UK in the same period. That killed inflation in the 70s. Australia didn't do that. We had this wages prices accord running through the 80s, so we had high inflation through the 80s. It was only when Paul Keating said we've got to have a recession to stop this, so we had the early 90s recession. That was deep, as deep and hard and tough on Australians as the early 80s one was in America. That's what we need again.
Yeah.
Do they have the political guts and will, both the central banks and the government, to cut spending, raise taxes, raise interest rates at that point again? And the answer is, I don't think so. So that means longer inflation and stagflation for some time to come yet, rather than a nice, quick inflation plus
rather than hitting the reset button.
Yep.
And a part of the problem from markets' perspective is while this inflation picture is still unfolding, the interest rate outlook is still somewhat uncertain. Any form of uncertainty is just generally causes skittishness, like the last week, up 5%, down 5%, and on it goes. You talked you touched on just before around company profits, that there actually was a lot of solidity there, and you wrote a piece in your most recent monthly report on the profit season. But do you want to talk more broadly about Australia and elsewhere, what you're seeing?
Yes, well, Australia, ultimately share prices are driven by expectations of profit and dividends. So the idea of a recession being scary is because recessions generally cause lower demand, lower spending, lower company revenues and profits and dividends, which it historically has done. And therefore shareholders get scared and say, well, that's not going to be there next year, so I'll sell. In pre-COVID, the Australian engine of the ASX-listed companies was making around about $100 billion, $100 billion in profits, pre-COVID, best year in 2019. And of that, they were paying around about $65 billion in dividends.
Yeah.
So 100 billion profits, 65 billion dividends. That collapsed to less than $40 billion profits and less than $20 billion dividends in 2021. 2022, which is just gone, we've seen profits get back to more than $100 billion and dividends get back to $100 billion. So probably, because some companies, particularly oil and gas companies, are December years, so we don't know what that
the lag effect of that. Yeah.
But by and large, both profits and dividends are back to higher than where they were pre-COVID. Now, whatever you can say about interest rates.
Some of those oil and gas ones that will revert, they'll take a bit longer, but some of the other commodity ones will already be reverting now.
That's right. So they have bumper profits. So 3 companies, there are 2,420 companies listed on the ASX. 2,420, odd. 3 companies produce more dividends than the rest of the 2,417 combined.
Right.
And they were BHP, paid out around about 25 billion Aussie dollars in dividends this year, just finished to June. Rio paid, this is Aussie dollars, they report in US dollars, but we get paid in Aussie dollars. Rio paid about 12 billion Aussie dollars. Now, going back to a step, BHP's dividend payment this year, 25 billion Aussie dollars, was more than the entire 2,400 dividend companies worth of dividends paid out amongst them all last year. So one company paid more dividends this year than 2,400 ASX-listed companies paid last year. Now, they were based on iron ore prices of $200+ a tonne during last year, and iron ore is only down to less than $100 now, so it's lost all of that. Most industrial commodities prices have fallen this year because of the slowdown in China and the surge, the recession talk in America and Europe. So those three companies, BHP, Rio and Fortescue, are trading on price-earnings ratios of single digit because everyone knows that's a one-off. So even though that's a big chunk of revenues and profits and dividends this year, the banks...
That will drop out. What does
that'll
it look
drop
like?
out, or that'll sort of halve next year. People aren't pricing them to produce that in the future. We never thought that would be that high, so it's a one-off, so it's great, put it in the bank and spend it. But by and large, the total profit engine of American companies and Australian companies is now well above what it was pre-COVID. Population of the world is a bit higher, spending's greater, inequality's higher, so the rich are spending more. The poor have got sitting on trillions of dollars in their bank account that they're now spending up with on things. That's why inflation's rising. So there's still a lot of money sloshing around. Companies are making a lot of profits, paying a lot of dividends. So the recession next year, probably across the world, will take out some of that, but that's only a year or two. Recessions get sold in a year.
So you're saying the companies are in reasonably healthy P&L perspective heading into this to wear some of the pain.
P&L's strong. Balance sheet is less strong. There's a lot of debt.
After a decade of cheap interest rates,
there's a lot of deliberately central banks cut rates to zero and gave out free money in order for people and companies and households and governments to borrow up and gear up because they did. Now they're stuck with the debt. If you look at a balance sheet, the assets are all fluffy. Asset values are very hard to put a picture on. The liabilities are hard liabilities. You know you owe the bank $1 million. That's not going to go away. Your assets are fluff. How you value things is all over the place. So the balance sheets are not as strong as the P&Ls. P&Ls are very strong around the world, including Australia, but the balance sheets are carrying a lot of debt. A lot of it's long-term debt, which is better. Pre-GFC, everyone had a lot of short-term debt, and they couldn't roll it over in 2009, so you had this massive banking crisis. This time around, the length of debt across the spectrum, governments, households and corporates are now borrowing 20, 30, 40-year money, whereas they were borrowing 2-year money pre-GFC. So the length of debt will make the debt problem easier to deal with because it takes longer to roll it.
And longer fixed rates, potentially locked in at very low levels.
That's right. So governments are now borrowing at 30, 40 years. So even though bond yields are rising, they were less than 1% 2 years ago, now they're 3 and 4%. They won't need to be rolled until 20 years' time. So they look scary, but the actual servicing cost of those debts is actually quite long. So governments, even Australian governments, quite well placed because of the long-term nature of the debt compared to a lot of corporates who are still short-term funded. But things like property trusts, they had a lot of troubles in the GFC because they had very short-term debt they couldn't roll.
And very high debt levels as
Those same property trusts are geared far lower now. They're sort of 20 and 30% compared to 40 and 50%, and they're on 5 and 10-year debt, whereas they were on 90-day, one-year type debt. So you're not going to have the global banking crisis and the global debt crisis you had in the GFC. But it'll be tough, and profits will be cut, and spending will be cut, and unemployment will rise. Meanwhile, companies like the big companies across the world and Australia just keep churning out revenues and profits.
Your big, as you discussed at the start of the podcast, the big technology players and others will continue to plough on. You talk a little bit about coronavirus numbers in your latest report, which we haven't touched on in a while.
I haven't
dusted off that chart.
Haven't dusted off the chart for a while, so I thought I'd pull it out and update it. Basically, we had the Omicron surge at the start of this year, December, January this year. So infections went through the roof. They came down into BA2 in about August, and that's come down again. Now, our base case is always going to be this thing's not going to be solved. There's going to be continued strains for years and years and years, probably, and as vaccines get better and more comprehensive. And we're seeing now some comprehensive vaccines come out. So the red line on the charts is the infection rates, which are running at $2 or $3 million a day, and they're easing. What is important is the hospitalisation and now the death rates. Death rates peaked in about April last year into 2020, and even though infection rates have gone up and down, the death rates have been declining steadily. So
you'd argue the vaccine plus a bit of herd immunity is doing its job.
That's right. And also, which is not a good aspect, is that a lot of the world now, like Australia, we don't report daily, we report monthly, weekly. A lot of the world, like the whole of Africa, it simply hasn't got the infrastructure to report, let alone to vaccinate people and to put them in hospital. So that may well be understated on the numbers, but certainly the Western world, the rich world, Australia, Europe, US, UK, Canada, that certainly looks like it's solved the problem, all except China, which is still trying to cut down. China haven't had a death reported since April 2020. and they close down every week. They close down more cities, which is causing a lot of problems with their manufacturing supply chains and their building boom,
causing other inflationary pressures around the world. And I'd like to finish on one of your key topic your closing topic from the last monthly, which was you listed out all the reasons not to invest, and then went on to make the case to say keep on investing anyway.
Well, for those who haven't read my monthly report, which was I think dated 3rd of September, I gave away a free board game.
Right.
And the board game is Spot the
Twister.
Crisis. So there's always somebody saying, what if I was going to say Taiwan invades China. China invades Taiwan. What if Putin drops a nuclear bomb? What if there's a big recession? What if there's a massive who knows what explosion or whatever?
We can never eliminate these what ifs. Yeah.
So I've got a board game which shows a chart, and this is a chart of, you can't see it here, but you've got the red line, which is the Dow Jones index since 1900 in Aussie dollars, and the green line is the All Ords index in Aussie dollars since 1900.
So if anybody wants to go read this and absorb it, it's on page 8 of the latest monthly report.
And the idea is there's 123 good reasons not to invest, including world wars and bombs and assassinations, and behind that there I've got literally every year all the reasons why you would not want to invest, including Second World War, First World War, bombing of Pearl Harbor, bombing of Sydney Harbour, nuclear scares, September 11. And the trick is to find it on the chart. So in October 87, the All Ords dropped by 50% in 38 days. Mm-hmm. Can you find it on the chart if it's such a traumatic event? 70 million people died in the Second World War. Can you find it on the chart? It'll take you 5 minutes to find it on the chart. Mm-hmm. The point is that the engine of profits and the engine of share prices and dividends in Australia, US at least, has been remarkably consistent and stable, and that line just keeps going through all sorts of crises. So yes, you can pick a reason not to invest. Russian default, long-term capital management, US Caesar steel mill, Suez crisis, they're all there. Assassination, bombs, etc. But can you find them on the chart? Probably not, because the share market just keeps rolling on. So if
it's also a testament to the resilience of humankind. No matter what happens in the world, we sort of find a way to keep on through it, and the share market just reflects that.
There's not a lot of human kindness on that chart, but you can see shares power through it. Now, I'm not trying to make light of world wars, but it is very hard to find the impact of these dramatically traumatic social, technology, military events on humans, but companies somehow find a way to get through it all. So when somebody says to me, what if China invades X? I say, well, they did 100 times worse in X to Y, Z years. Good luck finding them on the chart. Anyway, it's a bit of fun. But it just reminds people that share markets, profits, dividends have the power. Companies have the power to be flexible to find a way, and they do find a way.
No, it's an excellent chart, and I encourage everyone to go check that one out in the September monthly report.
Next month is Twister.
Next month could be Twister. Well, next month, so almost in a blink of an eye, the next quarter rolls around again. So we come to the end of the September quarter. We begin to sit down and look at asset allocation, positioning again. As we talked in our podcast last month, where we are reasonably defensively positioned at present, and not necessarily any likelihood that that's going to dramatically change in the immediate weeks ahead, but we'll be able to come back here and share with all the listeners how we see the immediate months ahead after doing that process.
Stay tuned.
Thank you very much, Ashley, and thank you to all our listeners.
Thank you all.
Take care, and speak with you again soon.